A happy Monday to one and all. All right, we're going to start off with one is I've got some magazines. I leave them in the classroom. One's Strategic Finance, one's a Journal of Accountancy. One's for CPAs, one's more CMA oriented.
There should be stairs on like every hallway almost. But if you go right out right here,
in the classroom, but
there's outside stairs right there.
And I think someone needs to be muted because I'm hearing all kinds of feedback, but that's okay. And in the box is by the windows. So if you pass by the classroom and want to grab those, feel free to take them. They're yours to keep. You don't need to return them. This is not a library loan. These are some materials that you might find interesting and useful. So by all means, take them off the front table when you're in the class, or like, as I say, they're in the classroom by the window in a box with a whole bunch of annual reports. So you can find those and grab those. The other thing I wanted to announce, I'm going to share the screen to do that. We've got some extra credit and professional activity credit opportunities. I've mentioned some in the past. I'm going to summarize them here. There are 4 I'm listing. First one is Big Data Analytics Night, a week from Thursday at 6 o'clock. The Accounting and Finance Club, but again, not just for accounting and finance majors, is sponsoring a happy hour. We do a monthly happy hour. And we also do every Wednesday. If you want to get more active, you're welcome to come at 6 o'clock on Wednesdays to the planning meetings. But it's Big Data Night. We have our dean, Dr. Harry, will be speaking, as well as a community guest who's been active in big data and is an alum of, I think, 2011 or 2012. One of our alums will be coming back to share insights. Secondly, I'm doing a presentation this Thursday for the Chamber of Commerce, and I'll actually flash and show a screenshot of the actual presentation cover sheet. That will be, there it is, by the numbers, reading, understanding, and using our financial statements. For the Chamber of Commerce, and co-sponsored by the Kelly Center for Economic Development, which is affiliated with FMU. If you're entrepreneurial, if you're planning a business, it's a pretty good resource. Or if you know somebody that is, it's a pretty good place to go. But that's a presentation. It'll be 9:30 to 11:30. And frankly, it'll be a good review of some of the stuff we've already done and good insights into some of the stuff that's coming. But it's a 2-hour process, fairly intense, fairly interesting, hopefully, and you're welcome to participate. I'm going to ask you if you're going to be participating in any of these in a minute, so I'll get back to that. President's Bowl is coming. Last year, the AFC had 2 teams and one made it to the semifinals. $3,000 is up for grabs. There's a number of rounds. It's a college bowl round. There are teams of 5, although I usually get together 6 in case so there's a backup person in case someone can't make it. And it is usually sponsored by an organization. And if you want the AFC to sponsor you, that's what you're welcome. Frats, sororities, any other clubs, activities on campus, worthwhile to get involved and hopefully to maybe win some prizes. And finally, the PD Idea Challenge, annual event. This one's 10 grand up for grabs. So these are monies that are awarded to teams, first place, second place, and it's a business plan. This involves a few more schools. President's Bowl is just FMU, but the PD Idea Challenge involves a couple of other campuses as well. So I'm going to ask you right now, here's my attendance question for the start. In the chat, put 1, 2, 3, 4, any combination of the above or none that you might be interested in participating. So think if you think might go to the Big Data Night, the Chamber event, the President's Bowl, the PD Idea Challenge. Put 1 and 2, 1, 2 and 3, 1, 2 and 4, 1 and 4, 3. Whatever it is that you think you might want to participate in, no obligation. We're not putting you on the hook. We just want to gauge interest, or put none. You're not required. These are all extra credit. I think you're required professional activity credits. Everybody needs at least 8 or 10. I don't remember the numbers. Anybody remember offhand? Maybe 8. Okay. But by graduation, you need to participate in some of these events and some of these activities. So get 4 out of the way right away, if you like. But I would welcome your feedback, and I've seen the chat. Thank you for the response, and I've seen the interest, and that's good to know. And I will share, if you are interested in number 2, I'm going to go ahead and show you where in the syllabus it was. The syllabus, there it is. So this was under February 4th. Actually, tomorrow, there's another presentation. The director of the Kelly Center, Liana, is presenting Essentials of Business Planning and Funding and Growth. I'm talking about by the numbers, reading, understanding, and using financial statements. And then there's another one next Thursday, Paul Schmidt. I'll be talking about financing as well. He's a banker, lending, so we'll be talking about the money side. So mine is more of the accounting, and it's reading, understanding, and using financial statements. So looking forward to your participation if you do, and still looking forward to it even if you don't participate. That's okay. Any questions on the events coming up? Anything on your mind? By the way, no class on Wednesday. It's a Patriot Pause Day. There's no spring break, so I think we're getting 4 or 5 days, some Tuesdays, some Wednesdays, some Thursdays. They're not doing Monday or Fridays, but we'll have, this Wednesday is the first of the Patriot Pause. So there will not be class here, although I'll be available if anybody wants to reach out and wants to talk about anything. Happy to accommodate and go down that direction. All right, let's go ahead. I'm going to start talking. You got a preview on Friday of the debits and credits of the world. And when we talked about that, we basically said debits are on the left. I'm going to use DR as an abbreviation. Credits are on the right. If you try to think about the way the bank credits your account, or a credit card company will credit your account, or any other credits in the terminology in the English language, you lose. You will get confused. It's confusing enough without trying to figure out, well, the bank debited my account. No, they credited my account, but they debited their account. The key here is, remember, there's always a debit, there's always a credit, and there's always a balance. Debits equals credits. But the only thing that I can confirm to you is debit is left and credit is right. You can start with that premise, you're ahead of the game. Because sometimes we'll debit things and they'll go up. Sometimes we'll debit things and they'll go down. So if you think of a debit as an increase and a credit as a decrease, you lose. It depends where the account falls on the scheme of things. So when I was drawing these pictures before, you look at that, it says, you're putting assets on the left, revenues on the right, expenses on the left, liabilities and equity on the right. And yes, that's the way I purposely visually wanted you to see it, because normally in assets are a debit balance. What do you mean a debit balance? Normally positive debit, normally positive credit, debit. Let's talk about some of these accounts. Let's say we had, near and dear to all our hearts, cash. Cash is usually on the asset side, as are accounts receivable, as are something called prepaids, inventory, the fixed assets, land, building, equipment, tangible assets. Those are all typically on the asset side of life, on the left-hand side. Then we get liabilities, things like accounts payable and notes payable, bonds payable. And we might have, and I'm going to put in here, unearned revenue. See, wait a minute. I thought revenue was over here. Oh yeah, I got revenue over here, revenue. What's an unearned revenue? That's someplace else. And we've got expenses, like rent, like wages, like utilities, like supplies. And I'm going to have something maybe called COGS, or cost of goods sold. By the way, prepaids is also known as prepaid expenses. So you say, wait a minute, there's that expense word again. I thought expenses over here on my income statement. Well, I may have some expenses on my balance sheet. Revenues on my balance sheet. So let's talk about that. That's just some confusing terms. You're already confused enough with receivables and payables, I suspect. Things that are owed to you, things that you can turn to cash, things that you own are considered assets. We've gone through that. Things you'll use up in the business. The business will consume them to make money. Inventory will get sold. Buildings will be used up. Vehicles will be used up or sold. Maybe after a couple of years, you use some of it and then you sell the rest of it. But now we have prepaid expenses. What happens if you bought a $1,000 plane ticket to go over to Singapore to do business? And you're flying out next week safely. And what's going to happen? Well, cash is going to go down by $1,000. I just wrote the check. I've got a ticket in my hand that says I can go to Singapore next week, but I haven't used it yet. What happens if the airline goes on strike? Stewards, stewardesses, pilots, doesn't fly. I sure hope I get my money back. They owe me that $1,000. That's prepaid. I can't put it into my expense category right away until I take the flight and use it. How about a Super Bowl ticket? What happened if they cancel the Super Bowl and you have these tickets? Are you going to say, that's okay, just keep the money? I think not. You're going to want your money back, and you'll be rightfully to get it back. So you've got these prepaid expenses where after the plane takes off, after the Super Bowl is played, now we transfer it from our balance sheet as a prepaid expense to a real expense that goes on our income statement. The same thing for unearned revenue. The airline has unearned revenue. That $1,000 ticket, if they cancel the flight, they got to pay you back. So that's their liability. That's their obligation to pay you back if the plane doesn't fly. And depending on contractual, even if it does fly and you don't go, you maybe do money back depending on the class of ticket. Don't worry. So we've got unearned revenues and we've got prepaid expenses, and they're kind of opposites. It's like your payable is my receivable. If you owe me money, that's my receivable, but you're going to pay me out of your payables. And I saw a hand.
I'm wondering, like, with the business, if they order materials, is that considered like a prepaid expense until they actually receive the material, whatever they may be? Like shipping, they may not be able to produce enough, or the company shut down or whatever. Shipping in those materials, that be on the same thing?
Same idea. So great question. The stuff you order, let's say you're making cars and you need batteries. So you say, Delco, I need some batteries. Ship me some batteries, or Sears, or wherever you're going to. You would say, I want batteries. And they say, great, we'll ship them to you. When you get those batteries, they go into inventory. They're not an expense yet. You haven't sold the batteries, you haven't sold the cars. At the time you sell the car, you're going to move the battery, the body, everything else with the car, all the tires into the cost of goods sold because you sold it. So now you have revenues, expenses. When you buy inventory, you have zero in expenses. You go, wait a minute, I got stuff on the shelf. That car dealership we established. Remember last week we set up a car dealership. We bought 5 cars at 20 grand a piece, $100,000 worth of cars. Is that an expense of our business? Not yet. It becomes an expense when we sell for 25 grand one car. We're going to have revenue showing up. We're going to have cost of goods sold at 20 grand showing up, but that's not until we sell the car. Otherwise, it's sitting inventory. So all the pieces and parts and supplies you bought, it's sitting inventory. Now, typically, you incur an obligation. You say, ship me 5 batteries. They ship you 5 batteries. I got 5 batteries. And I owe you. I got to pay in the next 30 days. And I got to pay it. When I write the check, I don't expense it then. I don't add more inventory because I already took care of the inventory and the payable. I just kick it out of cash. So the cash transaction is separated from the actual content of the actual order, processing, and receipt of goods. Because I get payables and receivables. If I pay cash, sure enough, I get the stuff today. You go to Best Buy and buy a computer for your business. I got a computer, assets up. I got cash, assets down. Debiting my computer fixed asset, I'm crediting my cash. We'll see how that works in a few minutes, but that's going to be the process. You're going to get pretty good at debits and credits. It takes a while. We're not born natural this way. We're born to drink mom's milk. We're not born to debit and credit. That's not a natural process, but it's learnable. It was the late 1400s. You heard on Friday, Pacioli. It's a monk that actually, I don't know what they were doing with the wine, but they had some good wine, and they made double entry accounting, which is why you're learning it now. This happened over 500 years ago. And the content of what you're learning has been used for a long time, but it helps us understand what we're doing. There's a seminar I'm doing. It's about understanding the financial statements and creating. It's understanding the books and making decisions based on it. That's why we look at these statements, because they tell a story. And the story they tell, sometimes good, sometimes bad. But we make decisions based on those stories. So here's the big picture of what we're trying to do. So let's go ahead, and now I'm going to go ahead and we start our business. When we start our business, let's say we start out with common stock to the tune of $20,000. When we put it into the business as cash to the tune of $20,000. There's our initial investment. We're starting a business. Whenever I do journal entries, and you saw that there were debits came first, credits came next last Friday. So I always start with the numbers. 20K, 20K. I'm lefting. What am I lefting? Well, you can see up here, cash is on the left. And on the right, I got common stock. Okay. Now, a good journal entry also has something called the date. We run journal entry in good form, 1/1/X1, and a description. So with initial, yes. Go and put 20 grand in the business. I lefted my cash, I righted my common stock. Or in accountant speak, I debited my cash, I credited my common stock. Did cash go up or down? Up. Did common stock go up or down? They both went up. Wait a minute, I thought you debit something, it went up. You credit something else, it went up. You bet. That's how it works. Now I'm going to take some of that money and buy some inventory. So I'm going to go in and let's do an inventory adjustment. Again, I'm going to start with the numbers. Let's do $5,000 worth of stuff. I'm going to make this supplies. $5,000. I'm going to pay cash. All right. Did cash go up or down? I wrote a check for $5,000. Give me a thumbs up, thumbs down in the pictures. That's why I like pictures. Thumbs up, thumbs down. Cash up or down? Down, big time. Okay. I'm going to be reducing my cash. Well, I told you that if I left it, it's going up. If I write it over here, I've got negative 5,000 coming out of my cash. What am I lefting? Well, I told you I got some stuff. Supplies inventory. So I'm going to left my inventory. So I've got inventory coming up at 5,000. Am I in balance? What are my total assets? Because I got 20,000 plus, took out 5,000 in cash, added 5,000 inventory. Yep, I'm at 20,000 assets. What are my liabilities right now? Zip. My equity, 20 grand. 20 equals 20, I'm good. How much have I had in revenue so far? Nada. Zip, zip, zero. How about expenses? I bought some supplies, didn't I? But I haven't used them yet. Zero expenses. Now I'm going to go back to GM. I'm going to say, remember those cars I'm going to be selling for you? You told me you'd give me a line of credit. You told me I could pick up some cars with no cash right now. I've got a business. I signed my life away. I have a personal guarantee that if something goes sour, you can take my house, my kids, my firstborn, whatever you want, you'll get paid. So I'm gonna go in and we're gonna buy one of those $20,000 cars. GM's gonna ship it to us. Did cash change? No, we're gonna owe the money. In the chat, can you please put accounts payable or accounts receivable when I'm gonna owe GM money? Is that accounts payable, AP, or AR? Just pop it in the chat, please. Everybody gets to play. There we go, thank you. Coming up. As part of the participation, I do review these. Seeing AP, excellent. You are right on track. Now, my next question, did accounts payable go up or did accounts payable go down? You just give me a thumbs up or a thumbs down. No, it depends about it, by the way. Pick one. Accounts payable went up. Good sign. I credit my accounts payable. I write in my accounts payable. It's up. Here's my 20 grand. What did I left? Anybody want to give me a tip or even pop in the chat? What is the account that's going to be hit on the left? Take a shot. You bet. Thank you, David. Inventory. So I'm going to take inventory. Left it. So there's my inventory. Another 20,000. Do I have any expenses yet? Not yet. What are my total assets right now? 20 plus 5 minus 5 plus 20. I have 40,000 assets. I've got 20,000 liabilities. And I've got 20,000 in equity. Am I in balance? I better be. 40,000 equals 40,000. Life is good. Let's go one step further. Let's sell a car. That's what we're in business for, right? We're going to go sell a car. Now, I want to go ahead and let's move. So we're going to sell a car. What do you say? We sold the car for 25? Click here. It cost us 20. So if I asked you, what would the journal entry look like to sell a car for 25,000? You'd say, oh, that's easy. I'm going to debit 25 and credit 25. And you're right. And that's going to put 25,000 on the revenue front and 25,000 somewhere else. What four accounts are going to get hit though? Because when we sell something, not only are we going to get the revenue, we've got to associate the expense. So in the chat, please type one of the accounts that you think is going to get hit. There's four accounts I'm looking for. Give me the four accounts that are going to get hit when I sell a car. And I'll share. Two of them are assets. One is a revenue, one is expense. Bingo. We got cash and we got inventory. Great start. Love that. Well done. We got cash and inventory. Can you think of the other two? Let's start looking at that. How much did cash go up or down? We sold the car. How much did we sell it for? 25. Did we get cash? Well, I just told you you did. How much did cash go up? 25. Is that a left or a right? It's a left, debit. So we're going to debit cash, 25. Okay. And then inventory. You told me inventory is being affected. Did inventory go up or down? That was a good time, even in the classroom. I got, you go up or down. Okay, give me a thumbs up, thumbs down. Inventory went down. Is that a debit or a credit? Let's see, cash goes up as a debit, cash goes down as a credit. So we're taking away from inventory. So we're doing a minus 20 here. We're crediting our inventory. Okay, I'm out of balance, by the way. Notice my assets are down 20 and my cash is up 25. That's not quite right yet. I got to worry about two other accounts. In the chat, can you think of what two other accounts are going to get hit from this transaction when I sell a car? Just type in the chat if you can think of. I get a vote for fixed assets. Fixed assets. If we were buying a car for the business, yeah, inventory went down. So the assets are whole. Fixed assets is equipment. And by the way, vehicles can fall under fixed assets if you're buying it for the business, or it can fall into inventory if you're a car dealership. Buildings will fall under fixed assets if you are a business, typically, unless you're a real estate business that buys and sells buildings, then it's your inventory. When I take my car into the shop on Wednesday, they've got a car that they use to drive me home. And that's a fixed asset for them. I suppose, well, he actually took it out of inventory, depends on how they use it. But let's see, I got to vote for accounts receivable. Is anybody going to owe us money once they buy the car? You just paid 25 grand in cash. How much more do you want? I mean, I love another 25 someday. They're not going to pay you anymore. But I do like one that said revenue. So we got these two income statement things we need to hit. How much revenue do we get? Do we get 20,000 or 25,000 revenue? Well, I sold the car for how much? I got 25,000. Thank you very much. So here we go. I'm going to credit my car revenue. $25 grand. If I stopped right here, my income statement would show a net income of how much? Well, I made $25,000 profit for selling this car. That's cool. Except I didn't. How much did I really make? You know how much I made. I made, well, the car cost me 20 and I sold it for 25. I made 5. But how do we get the accounting records to reflect that? Well, I need to put an expense of some kind here for $20,000. I'm going to call it costs. I mentioned it before. There's $20,000 left. So here's our cost of goods sold. So here's our journal entry. What's my net income? I look at this. I got 25,000 revenue, 20,000 cost of goods sold. I get 5,000 in net income. Where on the balance sheet is this net income going to show up? Because we adjusted our assets 25 up, 20 down. We're ahead of the game, 5,000. Our assets are up $5,000. Either another asset has to go down 5, or liability has to go up 5, or equity has to go up 5. In the chat, type which of those scenarios you think is going to happen. Is my assets going down 5, my liabilities going up 5, or my equity going up 5? One response in the chat so far. Let's get some more. You, 3, keep coming. So we're upping equity. Yep, good answer. Again, no, it depends about it. I know this is an off day for me. I know you want to say it depends, but today I'm trying to get some definitive directions. Although it depends, a case can be made for some other things. But in this case, it's equities being hit. Does anybody know what 2 words, not it depends, What two-word account is going to be hit in equity? It's going to get adjusted right away as soon as the transaction hits the income statement. Where does net income flow to in the equity section of the balance sheet? What's the name of that account? Retained earnings, ding, 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 well done. So we've got an account, in addition to our common stock, in addition to our additional paid-in capital, we've got something called retained earnings. And I better talk about it now because retained earnings, as you remember, starts with beginning retained earnings. You add net income, subtract net loss. You subtract dividends, you get ending retained earnings. So in that formula, beginning retained earnings was 0, my net income was 5, my dividends were 0, my ending retained earnings is 5. What does that tell me? My retained earnings now is to the tune of $5,000. That's the flow. That's how this stuff comes together. As soon as you change the income statement, the balance sheet reflects it immediately. It just flows into retained earnings. That's the relationship between these two statements. And when you see that relationship, you can start saying, oh, if I take my salary expense, my cash goes down $2,000. My expenses go up $2,000 for wage expense. My net income goes down $2,000, and my retained earnings goes down $2,000. Oh, I'm in balance. Yay. Assets are down $2,000, equity's down. Just by writing an expense check, paying utility. When I pay a bill that I've already recorded, I've got my payables being debited, being reduced, and my cash being credited, also being reduced. My liabilities go down, my assets go down. But what's nice about that, I didn't expect my net income at all. I already expensed it when I recorded the payable. I record the obligation. And then I'm just paying the bill, the cash is changing hands. So that's the flow of all these transactions into this big picture. And once you start internalizing that, feeling it, seeing it, and sensing it, this is going to make a lot more sense in the words. Again, for some of you, this is the first or second time you're seeing this. Some of you have seen it before. But I want you to make sure you're comfortable with the big picture. And once we've got this big picture and this perspective and understand how things flow, we can make evaluation, we can make decisions, and we go down that road. All right, I'm going to stop the share for now and see any particular questions on mine. Anything trouble? How many feel like I got this? Yeah, I'm getting it. Or it's been a long day and I'm going to need to watch the video. I think most of you are kind of getting it. It's going to take some practice. It's not natural. As I say, we're not born this way. But you will get this. We'll move you from here to here. That's my job and your job. We're in this together. Okay. So let's go ahead and I'm going to do a couple of the videos. I'm sorry, a couple of the slides. I just want to see what's going on. Oh, thank you, cost of goods sold. By the way, sometimes you see COGS, cost of goods sold. Sometimes you see costs, cost of sales, COS. If you're ExxonMobil, it might be cost of oil. Whatever goods you're selling, the cost of goods sold is when Belk buys clothing. Their cost of goods sold is there, and then they have these other expenses, like utilities, rent, whatever it might be, wages, phone systems, depreciation expense, we're talking about some of these. Okay, let's go back over and take a look at our PowerPoint a little bit and see where we're going with this. So you can see the accounts, asset accounts, liability accounts, equity accounts. Talk about some more of those. Asset accounts, everything there should be fairly familiar by now. I got cash. I can get paid by the receivables that money is owed to me. Or a note, I issue a note to one person or a company, they pay me back. I've got these prepaids. I might have prepaid insurance. Let's think about that. if I write a check on December 15th for next year's insurance, I'm prepaying my insurance. That's an asset. But what happens if the building burns down December 26th? Day after Christmas, nobody was there. They were closed Christmas week. Do I need that insurance next year from January through December? No, hopefully my other insurance company will cover the insurance loss when I have the building burn down. But I want my money back. I'm not going to insure my $1 million building for $1 million if it burned to the ground. So that prepaid insurance, I can turn to cash. Or I might allocate at the end of January, I'll take 1/12 of that expensive. In February, I'll take another 12th. In March, another 12th. By the end of the year, I'll use up all that prepaid insurance, prepaid rent, prepaid plane tickets, prepaid Super Bowl tickets, whatever it might be. Supplies, inventory, equipment, buildings, land. Okay, so we should be familiar with all that good stuff. Liability accounts, accounts payable, notes payable, mortgages payable, bonds payable, unearned revenue. The Super Bowl. You've got tickets that you bought, and they've got unearned revenue that they can't put in their income statement until the game is played. The airline can't take those monies and say, for the money, it's revenue. They need to give it back to you unless the plane flies and you're good to go. And the insurance company. If for some reason your building burns down in February, I have a funny feeling you're going to want a refund on the rest of your insurance for the year. Then we go on to equity accounts. Now, these three accounts here make up that keyword account we just used. Revenues, expenses, and dividends show up in what? Retained earnings. And that was that additional paid capital I talked about, APIC, paid capital, like this par. These are all equity accounts. But the big one that we need to understand is retained earnings and how retained earnings changes. We add revenues, subtract expenses, subtract dividends, life is good. We're making sense. So let's keep going. The expanded accounting equation. You're already there because I've been showing you the income statement with revenues, expenses, but there it is. Assets, liabilities, equity accounts. Equity accounts is common stock, minus dividends, plus revenues, minus expenses. There's our income statement showing up on our equities section, also again called retained earnings. Each account name is like a page in a book. We'll talk about something called a chart of accounts. When we were doing those journal entries, let's see, we had sales revenue, we credited revenue, we debited cash, we debited cost of goods sold, we credited the inventory. Every one of those names, inventory, cost of goods sold, cash, revenue, shows up in the chart of accounts. As a matter of fact, we could have been specific. We could have had 3 different bank accounts and said cash went into this account over at First Citizen, or this account at South State, or BOA, Bank of America. Whatever it is, we could have 5 cash accounts, 20 cash accounts, 4 inventory accounts. But here in the summary, you'll see accounts receivable, supplies, prepaid insurance, equipment. Obviously, a chart of accounts has a lot more accounts than most businesses, but that's just a sampling. And then we have liabilities, accounts payable, and unearned revenue. We talked about unearned revenue versus prepaid expenses. We have equity, common stock, retained earnings, dividends affected. Revenue, consulting revenue, rental revenue. If you ever looked at the Walmart Walmart income statement, not only have revenue from stuff sold, but they also have membership revenue. Where does Walmart's membership revenue come from? Well, oh yeah, they own Sam's Club too, don't they? So they get I pay my check every year, $50 or $100. Anybody who's a member That's membership revenue. Good deal for them. Then expenses, salary expense, insurance expense, rent expense, supplies expense, utilities expense. Cost of goods sold, COGS expense. Those are all things that show up and are part of the big picture of what we're doing. So when I drew the picture before, and I said, you know what? Assets, liabilities, equity. You think it's sick of saying that, I have no doubt. Revenues and expenses. It's something called a normal balance. I know there's nothing normal about this, except the normal balance for an asset is a debit. The normal balance for a liability is a credit. The normal balance for equity is also a credit. The normal balance for revenue is a credit. Normal balance for expense is a debit. What this whole normal balance means is that normally an asset is increased with a debit. Normally, a liability is increased with a credit. Equity is increased, revenue is increased with a credit. Expenses are increased with a debit. Which is why if you said, oh, debits are up and credits are down. Well, that's true for assets and expenses, but that's not true for liabilities, equity accounts, or revenue accounts. So you can't just say debit's good, credit's bad. Or debits increase, credits decrease. Again, that's true for cash. If I debit cash, it's going up. If I credit cash, it's going down. That makes sense when you define it the way we defined it. A week ago, this probably would have made no sense. Hope it's making a little more sense now. Sometimes, and so the whole point is assets can go up and assets can go down. I don't always debit my cash, because if I always debited my cash would keep going up forever and I wouldn't pay anybody, including my employees, including my landlord, including my suppliers, including my owners. So it's okay to credit cash. It's okay to pay bills. It's okay to buy stuff. It's not bad that cash goes down. As a matter of fact, it's good. Good for cash to go up. It's good for cash to go down. It means you're doing something. You just kept going up and up. That means you're not doing much. So again, this is the big picture that I want to make sure you've got a handle on, and that's making sense. So let's take a little deeper dive. Double entry accounting. Twice as fun. As a matter of fact, we did quadruple entry accounting, right? We had not only a sale, but a cost of goods recording. So we debited, credited 25, we debited and credited the 20. And by the way, not all entries have one debit, one credit. We'll talk about compound entries next class, where you can have multiple debits and multiple credits. You buy a house, you pay a deposit, you get a mortgage, you get a house. So you've got 2 credits, 1 debit, and you're on your way. But we'll see how that works in a minute. All right. So double entry accounting, this is just a cash ledger account. Now we're gonna have ledger accounts for all kinds of stuff. So if we're gonna go get the picture here, I have cash. I'll have inventory. I have accounts receivable. I'll have accounts payable. I'll have revenue. I'll have cost of goods sold. So these are like a page in a book. These are called ledgers. We'll talk about posting from the journal to the ledger in a few minutes. The journal entry, debits equals credits. In our ledger or our T accounts, the difference, like in this case, cash, the difference between our total debits and our total credit is $4,800. This actually represents 1, 2, 3, 4, 5, 6. So this represents 9 journal entries. We debited cash for $30,000. I'm guessing we credited common stock or equity for $30,000. We debited consulting services revenue earned for $4,200. I'm guessing we credited on the income statement consulting revenue. We collected 1,900 in accounts receivable. We debited the cash. We collected the receivable. I'm guessing we credited accounts receivable because that money's not owed to us. It's been paid. We can't keep it as a receivable. On the other hand, my cash went down or credited 2,500 bucks because I debited supplies inventory or supplies expense, not sure which. I bought equipment for 26 grand, credited my cash. I debit my equipment, which is another asset typically. But then my rent, my salary, those are expenses on the income statement. I credited my cash for 1,000. I debited my rent for 1,000, rent expense. I credited my salary, my cash for 1,700. I debited my salary or wage expense for 700. I paid accounts payable. It just affects the balance sheet. I credit my cash for 900. I debit my accounts payable for 900. They both went down. So sometimes expense went up and cash went down. Okay, they're both debit balances. I guess that makes sense. One asset went up, one liability went up, or one asset went down, one liability went down, or one asset went up and one equity went up. Okay, that stuff kind of makes sense. Are we on the same page? It's going to take a while to sink in. I'm not expecting you to. I didn't test you on it today, although you might see something on Wednesday by the time you get some more homework done, get some more internalizing of the stuff under your belt. But ultimately, it will make sense. All right, let's go ahead. I want to get to the actual flow. 4-step process. Journalizing and posting. So we identify the transactions. Okay, got a bill in the mail, source document. Someone send me something and says, oh, I got a utility bill. I got to pay this, but let me record it first in my books and then make it a payable and I'll pay it later. I get it on the books to know that I have it. I'm going to analyze with the accounting equation. Assets equals liabilities plus equity. We're in balance. Good. Where does it go? Then I record the journal entry. And notice debit cash, credit common stock for 30 grand. That, one asset, one equity account. Debit supplies, credit cash. My cash went down 2,500. So I've got a net of 27.5 left. And my supplies inventory is up 2,500. My balance sheet still has 30,000 in assets right now. But now I reallocate it between cash and supplies. And then I go through a process called posting. I post to a page that says cash on it. I post to another page that says common stock. I post to another page that says supplies. And I go back to the same page that has cash. So my cash has in the left column 30 grand. In the right column, 2,500. And the net balance is 27.5 in what's called our ledger. And we're posting, we actually go through a process called posting from the journals to the ledgers, JKL, alphabetical. Journals first, ledger second. We're posting to a page. Just to take a big picture, let's go take a look. There, stuff on the screen. Take a look here. So here's our journal entry. This is called the general journal. Debited cash for 30, credited common stock. I've got a date, I've got a description. Journal entry in good form. Then I've got supplies, debited 2,500, cash credited 2,500. Bought supplies. Good form. Again, I choose the numbers first. And by the way, what I also do is I say, I sometimes forget my debits and credits, but what happened to cash? Cash go up? Oh, it's a debit. Cash go down? Oh, it's a credit. Okay, I got that half the transaction done. The other half, no matter what it is, has to be the opposite. In this case, common stock is the credit. But if I knew cash went up 30 grand, I would put that down right away. And I knew the 30 grand had to be credited somewhere else. Or if I spent 2,500 in cash, I know right away I need to debit something else. That's the flow. That's my understanding. And we'll talk a little deeper dive on, no Wednesday. We will have class on Friday. Any other questions before I set you free? And I I thank you for your time. And notes payable, yes, it's just a loan. That is a good question. Notes payable, mortgage payable, bonds payable, those are monies you borrowed and you pay back with interest. Notes receivable is the opposite. That's the money that you got you gave to somebody and they owe you. That's the corollary. On that note, have a wonderful, I won't call it a day off because I know you guys are working hard. Me too. I'll see some of you on Thursday. I'll see some of you on Friday. I may see some of you tomorrow. Thank you for your time. Stay safe. We'll talk soon.
Have a good day.
Thank you. You too. Good to go.